So this video is about what drives the stock market. You can hear all kinds of fancy explanations every day on television or CNBC, such as it's the economy, interest rates, corporate earnings, you name it. Well, I'm here to tell you that none of those are the driver of the stock market. Yeah, they play a role to a certain degree, as I'll explain, but they are not in any way the driver of the stock market. I will tell you up front what the driver is, and then I will explain in detail. The only driver of the stock market is money, a bunch of money flowing into the market. Nothing else, just money. In other words, it's just inflation. It's inflation like consumer goods prices inflation, like the CPI inflation. It's just inflation. It's just money. That's all it is. So let me explain. Um, so a stock price is the price per share. To buy a stock or an index, you have to pay the price per share times the number of shares you buy. If a share of stock costs $100 per share, then you pay $100 for one share. The only way the price per share can trade at a higher price is if someone pays more than $100 per share. The price cannot trade at a higher price unless more than $100 is spent. If more than $100 is spent, the share price must necessarily trade at a higher price. So think about it in terms of simple math. I'm going to offer you the price formula from the classical economists. And that is that price, P, equals D over S. Price equals demand over supply. So demand is the amount of money spent. So in the example we just had, suppose you have $100 that is spent for the supply of 100 shares. Then the demand over the supply would be 100 over 100. That equals 1. So if the supply does not change, i.e. if the number of shares outstanding does not change, then the only way the price can go above $1 is if more than $100 was spent. You would have to spend more than $100 to get the $1 price higher than $1. Can you imagine any other way how the price can rise above $1? If the supply remains at 100 and the spending remains at 100, how else can the quotient be different than 1? It cannot be. The only way you can move that number higher is with less of a supply, i.e. fewer shares outstanding, or an increased amount of money being spent. There is no other explanation. It's as simple as that. So every day when the price of a stock moves higher, moves to a new high, unless the number of shares outstanding has declined, and in general it doesn't. I mean, yes, in recent years, shares outstanding have slowly declined somewhat, but plug that into the formula. If they've declined 3% over the last 5 years, then the price can only be a hair higher. It can't be 10, 20, 30% higher. So if the supply is unchanged, then the only way a stock can trade at a new all-time high is by way of more money being spent for that stock than has ever been spent previously. Similarly, if you see an index such as the S&P 500 going higher, that means that more money is in that market than has ever been spent in that market previously. So if you think about it, it makes sense that um, the if the central bank, well, so let's start there. Okay, so where does new money come from? It comes only from the government's central bank. That is the only creator of new money. We use in America US dollars, and in America, it is only the Federal Reserve that can create new money. It prints new money. It creates it digitally on a computer screen. So the Fed is always creating new money, which is why we always have increased consumer prices, increased inflation. Well, of the money the Fed creates, a lot of it goes into the real economy and affects the prices of goods on the grocery store shelves, but a lot of it also flows into the stock market. And so money flowing into the stock market causes prices in that market to rise, no different than if money is flowing into the real economy, pushing up the prices of food, automobiles, homes, etc. So as the Fed is continually creating new money, and a lot of it is being plowed into the stock market by banks, broker dealers, hedge funds, prime brokers, and the like. Well, if you put more money in a market, it will necessarily drive up prices. So that is what the stock market is. It is just inflation. It is just prices going higher because more money has entered that market. If more money did not enter that market, it would be impossible for the prices to go higher. If you don't spend more than $100 for that share of stock, the price cannot go higher. It simply will not, no matter how great your economy is, no matter how low interest rates are, it cannot go higher if more money is not spent. So if more money is not spent, it will not go higher. If more money is spent, it necessarily has to go higher. You can't buy $100 worth of goods with $110 being spent. It would have to be $110 being spent. So I know this sounds strange because you've heard all your life and you hear every day on television or in the media that it's all these other factors driving the market higher, but it's simply not true. So let's look at some of these other factors and explain. So for the first one, the most common explanation for a rising stock market is that the economy is growing. That makes sense intuitively. You have a growing economy. People are making more money. The economy, companies are making more money. Well, the value of everything should be higher, right? No, wrong. Let's step back. What does a growing economy mean? Well, a growing economy means the production of additional goods and services. That's physical units. Well, the production, the goods is physical, the services are not physical, but it's not monetary. It's a service. So if you're providing consulting services, you're not providing money, you're providing a service. Let's take a simple service from the old days, like a travel agent. If a travel agent books you a ticket to Tahiti, you're paying them for that, but they're providing you a service. They're not producing anything of monetary value. You're paying them money, a monetary value for the service, just as you're paying a monetary value for a new car. But just as producing a car is not producing money, producing a ticket to Tahiti is not producing money. The real economy, companies, businesses produce goods and services. They don't produce money. So as they produce more goods and services, you have what would otherwise be the same quantity of money having to purchase more and more goods and services. So, for example, if you had an economy that produced only automobiles, you had $100 in spending, you had 100 automobiles, the average price of an automobile would be $1, right? Just like our stock example. Well, if you increase the supply of automobiles to 200, then the price of those automobiles, if that's the entire economy, must drop to 50 cents. $100 divided by 200 units instead of 100 units. So as an economy grows, it doesn't produce more money. It produces goods and services. You have the same quantity of money in theory. And so over time, as an economy grows and produces more goods and services, the price of each good and service would fall. And that's what used to happen throughout the 1800s into the early 1900s, up until, guess when, 1913, when the government created the central bank. Once it created the central bank and started printing money, it started creating money alongside the goods and services that were being created. And in fact, it created money at a faster rate, such that it outpaced the production of goods and services. So even though we had goods and services being produced, which lowers the prices, you had money being printed at a faster rate, therefore raising the prices. So in other words, with our mathematical example, if the denominator, the supply, went from 100 to 110, well, the numerator went from 100 to 120. So the demand increased faster than the supply. And that's the layman's definition of inflation: too much money chasing too few goods. I would rephrase it as the quantity of money increasing faster than the quantity of goods. So that's what happens in our economy. So when that happens, companies make more money. So money is flowing into the real economy, increasing the earnings of corporations, and at the same time it's flowing into stock markets, increasing the price of stocks. Yet people tend to think, most experts on Wall Street tend to think, that the stock market's going up because the earnings in the real economy are going up. No, it's just that it's inflation in both places. And so kind of proof of this is that, you have a PE ratio, the price to earnings, the price of the stock relative to the underlying earnings. Well, over time, PE ratios have gone higher and higher and higher. That's because money has flowed into the stock market faster than it's flowed into the real economy. It's flowed disproportionately into the stock market. So it's pushed prices of stocks up faster than prices of companies, of earnings of companies. So that's why PE ratios have gone up. But the experts on Wall Street think that the stock market price is reflecting something with earnings. It's not. It's not. It's just Inflation at two different rates at two different places. That's all it is. So another explanation of interest rates of cash flows are, well, I hesitate to get into interest rates. It's a little complicated. Um, I'll leave that on the side for now. But suffice it to say, it's not that lower interest rates necessitates higher stock prices. I mean, yes, if you discount future earnings, you get a higher number. But why do interest rates fall? It's because you print money. That's how they fall. And so printing money lowers interest rates and pushes up prices. Conversely, raising interest rates consists of printing money at a slower rate or stopping it altogether. You get a credit contraction. Prices fall a little these days, and interest rates rise. But that's a monetary phenomenon. That's manipulation. Interest rates are manipulated every day by the central bank, at least short-term rates, which also affects long-term rates. That's why I'm hesitant to get into interest rates. Let me go further. Discounted cash flows. They say the stock market is pricing in future valuations. It's discounting the future. It's discounting those future cash flows. Well, if you didn't have money printing, the prices in the future would be no higher than they are in the present. They would be lower. And so cash flows would not be any higher in the present. They would be lower. And so what is there to discount? There's nothing to discount. So, and then think about it logically. If the stock market is discounting future cash flows, if the stock market is portending the future, why is it not jumping up to the future price today? I mean, the stock market goes up all the time. Why doesn't it just jump up to the price in the future? Well, because we only learn, well, in one way, we only learn year by year that future prices will be higher. And then also the real reason is because there's no more money today being put in the stock market to be able to bid prices up to those future prices. So the stock market is not discounting future prices. It's just inflation. Dividends. We buy stocks because of dividends, supposedly. And in a way, that's true. But if you had no more money in the future than you have in the present, you wouldn't have higher dividends in the future. The dividends would be the same. Yes, a growing company that's new and innovative and gaining market share would have increased dividends, and you could expect an increased stock price from that. But not every company would have that situation. The average company would earn no more in the future than it does now. It would earn no more over time. The better performers would, but then for every Amazon, you have a Kmart that's falling as a result of the success of Amazon. So half the stocks would go higher, half the stocks would go lower, but on average, stocks would never go higher because there's not more money to push the prices up, and the companies wouldn't be earning increased dividends in aggregate because there's no more money for companies to be earning. So it's not dividends either. Lastly, what about sentiment? We say it's sentiment. It's feeling good about the economy, employment, whatever. No, that's bullshit. No matter how good you feel, you can't drive up prices with feelings. And by the way, we tend to feel better when the money is flowing, the economy is juiced up, and we think that means things are good. That's when we feel better. In a recession, which is the result of monetary tightening and monetary contraction, well, we feel terrible and unemployment rises. So the fact is, our sentiment is usually the result of monetary factors, not the cause of them. But again, regardless, no matter how good you feel, you can't bid a stock price up. You can only do that with money. You have to spend money to bid a stock price up. So that is the stock market. I know this sounds different and crazy, but think about what I said, replay it, do the math, put your price formula on your piece of paper or in Excel, and play with it. You cannot have a stock market going higher in price without more money being added. And we are necessarily adding money to the stock market every year, and that is why it goes higher. A rising stock market is inflation and nothing else. Thank you.